that the contribution of Vincent to contemporary social sciences is so far the thing which we characterize as the rebirth of Gabriel Tarde. That is, he published a book, The Science of Passionate Interests, together with Bruno Latour, on the economic anthropology of Tarde. But also, Vincent is the author of the most unbelievable ethnography of the bank, where he spent 18 months in the beginning of the 2000s, and nobody knew that at the time that bank would be the site which where Mr. Kerviel, the most famous fraudulent trader, was working. Now, to what extent these previous achievements are linked with Vincent's talk today, I don't know. He will tell us right away. And without further ado.
So my actual title is slightly shorter and less ambitious than the one that Oleg just mentioned. I should just extend my warmest thanks to Oleg and to people who organized this workshop for organizing this workshop. And I'm looking forward to the presentations. Basically, what I'm doing today is presenting parts of the findings of that research that I conducted a few years ago, and that basically produced that book. And that book is what I think one of the first attempts to address financial engineering from a social science point of view. Okay. From a sociological point of view, and as Oleg told you, and I will talk about that a bit later. I spent a few months, not a few years, in this bank, mostly interning. I was doing a PhD in mathematical finance. I knew I was not going to finish that PhD. I was only in the bank to actually collect information and to see what financial engineering was doing to the bank. The initial impulse was to understand how traders who had initially been trained to work in pits and who were initially socialized in a completely different environment had to absorb mathematical finance. So people who were trained as traders with very little interest for mathematics or physics, all of a sudden in the 1990s had to absorb a huge body of stochastic calculus and all kinds of sophisticated ways of dealing with uncertainty. And the idea was to see how these guys were actually dealing with that, and whether there was an impact of that on the markets and on the organization. So that's basically the idea of the impulse of the project, of the fieldwork. And before I get into the fieldwork, I just want to, because I think one of the idea of this workshop is to also lay the ground for what STS contribution could be to different fields, and one of its recent contribution has been to the study of markets, and not only finance but markets in general. So I just want to give you a very brief idea of where that project came from in the context of other STS scholars studying markets. And so the idea, and I'm just going to give you a few names. Donald Mackenzie at the end of the 90s started to move to financial mathematics and to the construction of markets. Michel Calon was also interested in 1999 or 2000. 1998 actually published a book called The Laws of the Market, which became pretty influential. And then in New York, David Stark, who was trained as a sociologist of organization, got interested in financial markets. And these three scholars had in common that they were either central to STS or that they were reading very cautiously STS findings. And they basically contributed to changing the field of sociology of markets and economic sociology in pretty deep ways. And basically one of their accomplishments has been to to start engaging a conversation with economists. And it's not clear to this day whether it was successful. I think it's not yet been very successful, but at least they have started a conversation with economic sociologists. Most of them were actually buying into a great divide that sociologists and economists had agreed on a few decades ago. And that great divide was the fact that sociologists were in charge of values, and this is a point that has been made by David Stark in a paper. And I think it's a valid point, and it's actually, in terms of history of sociology, it's an interesting point. The pact and the divide, the division of labor, was that sociologists were in charge of values and that economists were in charge of value.
Just the microphone, make sure there's less.
Okay. Are we changing the microphone, or am I just pushing the microphone? Okay. Okay.
Нет такого, что там, слова теряются. Всем понятно, все? Потому что если можно манипулировать, что как он был лучше или бедный, как он похож, аудитории было понятно. Не молчи, если что-то говорит, ладно?
And so this division of labor was, economists were in charge of economic value and sociologists were in charge of, values. And so there is a history to this division of labor, and you can see that if you read people who have been writing about finance in the past 10 years. One interesting monograph has been by an anthropologist from University of Minnesota, Karen Ho. Her book is entitled yeah, exactly. You will Karen Ho. And Karen Ho is interested in it's a magnificent monograph on the ethos of bankers in Wall Street. And she's interested in people who actually work in merger and acquisition, and how these people actually manage to assimilate the theory of shareholder value. But it's all about ethos. So all the models of shareholder value, basically how it came to life and how they basically play with these models in relation with their target companies, is completely left, to the side. So it's really, an old anthropology, old sociology of profession in a way, or culture, focused on this little very exotic group. And then you have on the other side, to go back to this division of labor, you have on the other side economists who are trying to make sense of the crisis. And one way for them to make sense of the crisis is to basically trying to look for moments of dysfunctional organizations or sites of dysfunctional organizations. And dysfunctional organizations immediately translate as fraudulent practices. Okay? So instead of being able to look at organizations that would be dysfunctional without any sort of fraudulent intent, they immediately translate crisis, dysfunctional organization as people having bad intent and trying to profit or manipulate the market. So in either way, you have not much space for what would be the contribution of basically the interaction between new designs, new products, importing new mechanisms and new formalisms into an old world, basically the world of financial of investment banks, and the fact that these two worlds would actually clash at some point. And so what people who do sociology of finance, social studies of finance have been interested in is actually opening up, seeing where this interaction happens. And basically been interested in mostly the design of the products, and also the fact that what happens in 2008 and what had happened in the 90s too was a tension between very innovative products and the attempt to standardize these markets. Okay, so that's what they're looking at. Have been looking at. So So the idea is that against this division of labor, there is space for social science, engaging economists and engaging sociologists in something that they were actually not so interested in doing so far, which is looking at the properties of the services that are being sold on this market. Okay? Not just looking at professions, not just looking at the structure of the market, but basically reconciling these, finding a way in which we can reconcile that. And so for sociologists, it was already the case that in the 1980s, people working in network analysis were interested in tying the questions of the price, which is the major questions and the only questions for economists, and the questions of the structure of organization. And that has been done in a really fascinating article in 1984 called The Social Structure of a Securities Market by Baker, who is now teaching at Chicago. But the thing is, once again, it's a really beautiful piece where it shows that different organizations, different exchange organizations produce different prices, which is really the question that economists pay attention to. But the one thing is that we don't know anything about what circulates. We don't know anything about the flesh of these markets. And it's not that we would want that, for sake of, a moment of exoticism, but it's also that it may actually make a difference in terms of price, the way these instruments are designed. And so that's been the focus of this group of scholars, trying to understand how a price emerged and how calculation is a social moment. It's a moment that is worthy of consideration for social scientists. One of the findings is that basically all the categories of economists, perfect markets, rational actors, cannot be taken for granted, but need to be investigated as such. So they are achievement, they are performance, and they can be brought to life. Okay, a rational actor doesn't come naturally; he's not naturally there, but he can actually be produced. And so the idea was in which circumstances are they produced? And so one of the other consequences is that there is no two domain, social and economic. But basically, the economic moment, the economic gesture, is a gesture that comes with intense calculation. And so that's why this group has been sort of mesmerized, fascinated by calculation. So I told you there is this interest from the start to reevaluate how sociologists and economists can actually contribute and can collaborate on these questions. And just paying tribute to Durkheim, which not many people will probably do in the next 2 days. The idea was that calculation was a needed sort of stage if we want to study markets, because they are the sites of most intense effervescence, of most intense economic activities. But what's interesting is that they actually do not come. Actors who calculate do not come unequipped. They come with prices, they come with formulas, they come with all kinds of equipment that help them to engage calculation, economic calculation, and produce price. So the idea, against the idea of Baker, of 1984 Baker, that we can actually describe markets just by looking at the morphology of these networks, we can probably understand markets if we pay attention to the whole ecosystem of these markets. And one element of this ecosystem is obviously the rise of all these calculative devices. And the related and very important consequence of that is that against the idea that we would have on one side the cold world of economic calculation and on the other side the hot world of moral principles, what these studies have been pointed to is the possibility of actually looking at the normative principles that guide some of these markets. And if we look practically at many of these markets, where each market has basically a set of normative principles, as being coexistent and as being co-produced by the set of calculative practices and calculative devices that come with these markets. So basically each market comes with its host of devices, and these devices actually set the ground for a distribution of responsibility on these markets. So just very practically, if you look at one of the raging questions that the SEC has to figure out these days, the question of algorithmic trading. Algorithmic trading is the existence of robots on the global financial markets that basically send orders every nanosecond or something like that. And they basically, so what the SEC people realize, sort of surprise, is that basically the prices are not driven by human traders, but by robots. And so they are all worried that robots may not be good traders. And so the way they actually discuss about how we must make space to this automated way of trading and leave space for human decisions is all about sort of setting how the responsibility need to be distributed in these markets. So so these are basically the findings and the consequences for future research that have come out of that field. So what I want to do now in the remaining time is to show you one of these products that actually started in the 1990s in Société Générale. So Société Générale in the 1990s was really sort of the darling of the financial industry. And early 1990s, they started releasing these products, and these products are called capital guarantee products. And the way they work was very appealing, and they made a lot of money, okay? They really made a lot of money. And what these products do is basically they combine nice features of insurance and investment. And it's a product that involves the bank, the engineers of the bank, so the various engineers of the bank, the traders, the salespeople, and most importantly, the client. It's sort of a customized product. And so I'm just giving you a scale.
Do the robots use this formula?
The robot, they don't use this formula. They don't, never. This is a human, this is a human, this is a human is behind this steering thing.
For those in the room who never read anything about sociology or finance, one of the main things which Vincent just basically articulated, which is a basic knowledge in the field, is that most of trading right now is done by robots, not by human beings. Most of trading is done by playing. When the price of stock falls to level X, sell that amount of stocks. And as a result, we do not control lots of trading, and that was what Vincent has just articulated. So I was wondering whether this product, which he will describe.
So this product, as you will see, is really not good for robots. Robots don't like these products. But so the principle of this product is that a client is going to bring money to the bank. And so this is a financial service. This is private banking. Wealthy clients or companies who were full of cash in the mid-end of the 90s. You have to remember the companies were actually producing profits in the 90s before the bubble. I mean, they're still producing profit, but in different ways these days. And so a company comes to the bank and say, I have $100 million. I need an investment. I'm interested in the security. I'm interested in the safety of a guarantee. But I also want the thrill of the investment. I want to feel that my money grows when the market goes up. And so it's a combination of, insurance. Whatever the market does, the company or the investors will get his money back at the end of the term. And the term can be 3 years, 5 years, 10 years, 15 years. So these are long commitments. But in addition to a 100% of nominal back, there is also the performance. And the performance, as you see, is not just, an average of the performance of each underlying. And I call these, and they call these underlying. So basically, you just pick a few stocks or a few indices that you like, that your company does business with, or that you as an individual want to protect against. There are many reasons why you would want to pick these underlying, and these are the underlying. It's basically the Euro stock, the American index, and the Japanese index. And so what the bank guarantees is not just, just investing on these and just giving you the average, but giving you more than the average, giving you 120% on that average. Okay? So practically what you see is that the bank cannot sit on the money. First, if it were to sit on the money and the market were to collapse, it would struggle to guarantee the money back. It doesn't sit on the money. It has to manage on a daily basis the money. And so that's the interest of this product. We see a product that looks not so complex. I mean, the math for anybody who has done just a limited amount, the limited training in mathematics is extremely straightforward. The question for the bank is how are they going to invest the money in such a way that they can guarantee the nominal back or the performance of 120%. So they basically have to be active. It's active management. And so what's important to understand is that you have only 3 underlyings on this product, on this prospectus, but there were products with like 20 underlyings. So now the question for the bank is how do I live up to the diktat of the prospectus now that I have $100 million? Just need to make sure that it grows up to 120%. So what happens is, and that's the gist of the study. I spent a few years in the bank studying how the bank was going to do what is the most crucial things for investment bank these days: to hedge. To hedge, which is to invest the money on different underlyings, to basically buying futures of these indices in such a way that it was not taking risk. And the way these products were designed by the engineers was that a trader could easily invest, and there were scripts on how to invest without putting the bank at risk. Okay, so although it looked risky because you have to actually reach 120% of the average performance of the 3 underlyings, there was a script that the traders could follow, which was pretty straightforward, where they would actually not take risk. So that's basically the entry in the bank. Instead of looking at, in addition to looking at where these traders were coming from, where these engineers were coming from, what was their training, how the training had to be sort of bent in order for them to assimilate these kinds of constraints. It was also to see how the transformation of the industry was a necessity through after the adoption of these products. So engineers were putting these products on the market, and then the bank had to follow. So that's the idea. The thing is this. Did I talk for 10 minutes or do I have 10 minutes?
10 minutes.
Okay. So what I want just to point to you with this product is that we have a sort of a situation that is slightly different from what people in social study of science have been sort of studying over the past 15 years. What they were mostly interested in, basically the questions of performance, which is how a group of engineers, a set of practices coming from accounting, coming from mathematical finance, coming from all kinds of disciplines sort of circulating around markets, have been producing markets. So that's the idea that Calon put forth in 1998 and then was picked up after Calon. So basically our markets are not natural entities but are produced by all these disciplines. And what we see in that case is a slightly different kind of value production. Okay. And that's what I call parasitic finance. And parasitic finance, instead of looking at the construction of a frame, is interested in understanding how banks like Société Générale were actually taking advantage of existing frames. And the existing frames, if we go back to the previous slide, the existing frame is the existence of exchanges. And the exchanges, they produce prices. On a daily basis, you go to the S&P, you go to the Bourse de Paris, and you have the prices. And these prices are there, they are public. And basically what Société Générale does, it basically grafts onto this overflow of information by the exchanges and design a product from that information, from the availability of that information. And so, unlike performativity scholars who have been really fascinated by the construction of frames, what I'm most interested with that kind of product, and you have to see that the capital guarantee products were the most lucrative business at the end of the 90s. Every bank was actually following Société Générale because they would see the profit that they were making. So it really became one of the dominant model of value generation in these banks. So instead of creating a frame, what it does basically create a product that is going to take advantage of an existing frame, but disrupt as little as possible the existing frame, the existing markets, and create value out of that. Okay, and so I call that parasitic finance. And you have to understand a parasite as, you have to make the effort of understanding parasite as something that is not negative, that is just a way of organizing coordination. Okay, and it's actually it's a very interesting form of coordination. Because it works as, it's asymmetrical. Société Générale was actually grafting onto these exchanges, sometimes onto 15 different exchanges, bending the information from these exchanges, creating a product. But what they really wanted not to do was to be recognized by the exchanges authorities as a main actor. So they were trying to stay under the radar and produce value in such a way that wouldn't disrupt the ecology of, these 3 indices or these 20 indices. Okay, so the idea is to produce value not by creating a market, but by finding resources in the interstices of existing markets, and in designing a product that would basically generate value, but staying under the radar of the authorities. So, and so the point of this product is really to avoid regulation and avoid the capture that the authorities would try to realize on these institutions, which is to try to tax them. The problem with these products is that because the clients were so central to designing the products, and because the clients were putting so much money, the bank had to make space for these actors. And so making space to these actors entailed changing completely the way the bank was organized. And because these products were in a way completely unique and tailored for each client, for each major client, bringing $100 million to Société Générale, basically the clients became collaborators with the engineers and the traders. When you have a client bringing $100 million, you can't just turn him down and say, no, we know what we do. We're going to design it the way we want it to be designed. We will give you the final package and you will just sign off on it. The invasion of the bank by the client had huge consequences. And the consequence was that the way business was done in the bank before the invention of this product, before the capital guarantee product, was completely disrupted. And basically the clients started to set the tone of what design was going to be and how pricing was going to be organized. So basically the ecosystem of the bank changed completely after the client came in. And the other related problem, because these products were customized, is that there was no market price for these products. And we know that from the crisis, because what we realized in 2008 is that the MBS, the mortgage-based securities, one of the many problems that they had was that there was no market price, because the banks were basically putting them on their portfolio, but they were not trading them on an active basis. And these products are exactly the same. The bank gets the money, generates a model to actually price these products. But the pricing of the product is a trading room and model-based activity. It's not that the bank is selling the product and buying it back like they would do on standardized product. once the bank has the product, has to figure out by himself what the risk and what the value of the product is, okay? So it changes completely the way, instead of the price being the natural outcome of a conversation between actors in different institutions, the price becomes the outcome of a conversation between different experts in the bank. Different financial engineers, quantitative engineers, traders who have the knowledge of how markets work and do not accept that the price be entirely derived on the basis of the price curve. So all these experts in the bank have different approaches to what a price should be and how this product should be priced. And so the formalization of this conversation is the model. But a model, there is no feedback from the market itself because there is no market. Okay, so that was basically the tension of Société Générale and most of these banks. By the time there was a lot of cash out there, the clients wanted to be associated with the design of the product, and the bank was not going to, tone down the design claims of the clients. They went, let them in the bank, associate them to the design. That would produce unique products, the pricing of which was a puzzle, and the risk management of which was really a puzzle. So what you see is that these, and because I probably have 1 minute, that section, my 30 slides show turned out to be a 3-slide show. So what's at stake in 1 minute? What's at stake in these kinds of study and in sort of trying to understand the technicality of these products is that over the past 20 years there has been an exacerbation of a large question among people interested in finance, just not interested in making finance, making profit, but studying and thinking about what's finance and how its contribution is to the creation of economic value. And so basically the conversation has been between people who look at finance as information and people who look at finance as a process of abstraction. And so people who look at finance as information are basically financial economists, most of them coming from the 1970s and the revolution in financial mathematics in the 1970s. And the best example of that is Merton Miller in an article in 1985 who basically defines finance and say, regulation is just a lost cause because finance is all about information. And as we know, as economists know, information is a very elusive thing. So you try to capture it, you try to control it this way, it just moves the other way. So, the SEC should just give up now and let us deal with what we do. Finance is nothing but information. And so the topography of this imagery is that you have like a puzzle. And all these new financial instruments are actually adding one piece to the puzzle. And the dream of these financial economists is that in the long term, we will have like the full puzzle, and the future will be taken into account, or the possible future will be taken into account by pieces of this puzzle. So we slowly complete the market, okay? And these products do nothing but complete the market. So that's the idea that, finance, why should we look into banks? We just know out of the hypothesis of competition, a strong competition, that they are just completing the market. And you have against that vision the idea that finance, and this is from a completely different crowd, it's mostly from social science, some sociologists and approaches, that finance is just a process of abstraction, okay? And what finance does, and so as you see, it goes all the way back to Rudolf Hilferding, sort of fleshing out the insights of Marx on finance capital. And the idea is that finance capital is just abstracting and impoverishing what the real economy is. So once again, you have sort of a completely different topography. And instead of having this puzzle that extends to the infinite, and by adding new pieces to the puzzle and completing the market, the topography of the finance abstraction is that you would have like the real economy. And the notion of real economy actually is what they use. You have the real economy. And then on top of that, you have a process of abstractions. And basically, financial engineering is just this process of abstraction. And what we saw in 2008 was a process of abstraction that lost touch of the real economy, because you were securitizing, bundling, securitizing ad infinitum, so that the bank that was buying the final package had no idea what the risk of the mortgage was. Okay, so that's a process of abstraction. And the idea with the problem with these two sort of imaginaries is that on one side, finance is information, and it disregards completely what is the process of creating new financial instruments, and the complexity that you have to actually that comes with going from data, price data, to instruments that you would price. And this is not, and it's not information all the way through, right? You produce information, and what you realize with looking at these banks is most of the time you fail to produce information. And the other metaphor, finance as abstraction, the problem is that you mobilizing the idea of the real economy, that would be the violence that would be done to the real economy through the process of financialization. The whole notion of the real economy is not clear. What is the real economy? Okay, well, how do you define the real economy? And people would usually define the real economy would mobilize the notion of real economy, do not define it. And so, just to conclude on the note, and where STS can be useful is that there are a few things that STS taught us. But one is that information and abstractions are not concepts that we should use easily or casually, and that generality, the generality of information or abstraction, is something that needs to be earned. That can't be used as a that is not easy for us to use as a simple concept. And I will just leave it here. Thanks a lot.
We've got 15 minutes for questions, and Maxime.
Hi, thanks very much for a very interesting, provocative talk, I would say. I'll introduce myself. I'm Maxime Wolf. I'm an economist here at the university, and as well, for 7 years I've been financial engineer in one of the British banks, so I'll say what I think about what you say. First of all, I'd like to say that I don't agree that economists, the only thing economists care is literally the price. Thank you. Because they also care about the volume.
But the volume
of the market. And well, I see where you're coming from when you say that the price for these products is not formed but in the process of negotiations. But the market for these products is essentially not a competitive market, so it's literally a monopolistic market. And then those type of markets, what's important for the price setter is not only to kind of take into account all possible sources of risk, but at the same time to rediscover the demand curve of the market. The demand curve. The demand for these products. Yeah. And basically the price will be a function of the demand, right? Sorry. It's not going to form in the process of negotiations as such. And in many markets, like products like you showed us, say I worked for ABN AMRO Bank, and what ABN AMRO did, like in the first half of the 2005, yeah. They would go into, say, a new market like Eastern Asia. They would offer a product like that, because the market was just really fresh. There were no competitors. They would charge any price just to get the volume, just try to rediscover the demand curve. And then as soon as Société Générale would step in, or other banks, they would just withdraw, because other banks had better abilities to kind of discover the demand curve for those products. So I would say it's completely right what you're saying, that the price for these products is model driven, but at the same time it's demand driven as well. And those products, they emerged as a response to the demand in the market.
Yeah.
And so it's kind of, I would say it's not quite fair to say it's just only the way financial engineers think about, like, well, we construct a really complicated model and then if it's wrong, then the price is wrong. It's true, like somewhat, but at the same time, it also depends on the ability of the bank to discover the demand curve for this product. So that's the main comment.
Yeah.
And well, yeah, and I'll just final point is that literally why I mentioned the volume at the beginning, because in the monopolistic markets, the volume is also important. And what happens now in the markets, especially, well, because I'm working for a Royal Bank of Scotland at the moment as well. So what happens with the Royal Bank of Scotland is that because it was acquired by British taxpayers, we don't care about the price anymore. We care about the volume. So we would charge the price which is not competitive, I mean, like more competitive than any other price, but just to retain the volume of clients. So, and from that point of view, it's no longer driven by the models or by anything else. It's just by the desire to kind of to get, well, to retain or regain the reputation of the bank.
Thank you. Should I take that or wait for other questions? What's the mechanism?
It depends how many questions are there. Well, Andy, you are number 2, then I'm number 3, and then we move to the panel.
It's just a simple question. You mentioned 2008 at the end of your talk. 2008, the enormous financial crisis that affected the world very badly. What does STS tell us about the financial crisis in simple words? What's the story?
Okay. Well, I guess...
Should I start with that? Not that, but that's right.
Yeah, sure, why not?
So the first thing is, so the questions of the demand. So it's most interesting because, as you know, this is and I insisted on that at the beginning. This is a product that sort of blur the question, so you had an ecology of products of financial services before capital guarantee product came around. Okay. And you have also portfolio. I mean, you had things that look like capital guarantee product, like portfolio insurance. In a way, they smell the same thing, right? Insurance and performance. But it turned out that one of the major problems for Société Générale, and to be completely fair to the grandfather of that kind of product, UBS started trading these products early 90s, and they had mispriced it. And as you know, UBS is as you can read now, is pretty. It's a cautious bank in many ways, and so they actually withdrew. They decided to stop, and that these products, these capital guarantee products, based on correlation, the risk is correlation between indices. They didn't have the expertise to do that. The problem for Société Générale, in terms of demand, is that there was no demand at first. There was absolutely no demand, which means that they actually, the way, talking about the cost of these products, the hidden cost of these products, bringing the client and teaching the client what would be hybrid between insurance and investment. It looked like, because the client is bringing $100 million, we can spend a few hours with him. But the disruption to the change, to the chain of basically the different tasks in the bank to bring the client was huge. And so basically trying to figure out how to sell these products and which client would be interested. I think mobilizing the fact that there is demand is not completely right, because what you need to actually produce demand. And so one way of producing demand, as we know, is you send products on the market. There is no market, there is no demand, so you have to find other ways of talking about it. But you basically contact people and you tell them, we have something new and we are very excited about it and we think you would share our excitement, but how do you talk about that? Because you can't say just that's the price. You have also to explain how it works, and they didn't really know how it works. That's the thing. So I think that the demand, we can't really take the demand to be something that would be external to that. They have to figure out how to create a demand for these products. And in terms of volume, volume, it counts a lot, and you are completely right to that. And it actually counted a lot for the bank because at some point in 2000, they were so successful that all the clients were coming, they didn't have to sell the thing. Because all the clients were talking to each other and say, oh, we have this amazing product from Société Générale, no risk, capital guarantee, fantastic product. They were accepting all that because the fees were still very high, because they were competitors, but they had such a reputation that basically the volume created all the evils in the bank. The volume meant that basically all the costs that were anticipated were wrong, and that there were so many hidden costs because the traders in the front office were not the ones who were in charge of the product. There were also all the back office people, and they were struggling to make sense of these products in a way that traders would not acknowledge, or they were just making fun of them. But and so what what STS taught us about the financial crisis is that basically finance is not information. So that's one big thing, and that also when you add the number of intermediators, or when you add layers of intermediation, you have tons of questions that need to be answered. And if you look at one of the main actors of the credit crisis, were the rating agencies. So we knew that rating agencies were bedfellows, were strange bedfellows, because they were grading and they were paid by the industry. But what we realized is that the transfer of expertise from different fields, from basically mathematics and physics to the financial industry and to the regulators, doesn't come easy. And that it doesn't flow naturally.
So if I said the whole thing was just a house of cards that fell down, would I be right or wrong?
If you were to say that about finance in general, I think I would have problems with that. Because then many people are actually just rejecting finance as all, saying, it's too abstract, right? What's the point of that?
Bunch of crooks.
And so, so the question is, when you have that kind of claim, is it's abstract. What does it abstract?
Okay. Well, I see the radical zeal in the eyes of Andy, but I have also another goal, which is didactic, to explain to the students. So my last question will be more or less asking you to be more explanatory. We had a summer school in science technology studies, so we read Mackenzie, we read Stark and Beyonze, we read Muniesa, we read others like Mirovsky, from the book Swedberg and others on the materiality of the markets.
Yeah.
STS means economic sociology. So if I had to explain what Vincent Lepinay is doing in comparison to these guys, I would have to pin you down to two main contributions to the field of STS and economics. The first one is, of course, Latour and his attention to materiality and things, and something close to what Knorr-Cetina is doing right now with Alex Preda, right, when she looks at the scopic technologies, at the fact that what you see on the screen is not a representation of reality, but rather is reality itself, and Knorr-Cetina has a very well-argued position. Another one you mentioned, this is the performativity of the markets, meaning this is basically Mackenzie and Calot after he split with Latour. And that's the idea that the economists do not reflect markets, rather their models are constitutive of the markets, even for the strawberry market somewhere next to Real. Now, where are you close to the first or the second, and what's the contribution? Is it within these two traditions, or is it next to it as an addition?
So I'm actually not very close to Knorr-Cetina for a series of reasons. The first reason, I think, is she's actually buying this notion that markets are a play between humans, and the humans are behind their screens, but they are still humans, and that she completely disregards, and she can't do that because she's working on currency markets, and currency markets are the least creative markets. And so she completely disregards the fact that markets are about products, and the fact that markets are about services, and that these services are designed, and that the design of these services actually bear a responsibility to the morphology of these markets. Okay, so that you can't say. I mean, she's.
So you're in the second tradition.
So I'm in the second tradition, and for the reason that I think Preda and Knorr-Stettiner, they are completely, they are charmed by German sociologists, by post-Husserlian German sociologists, and they are interested in markets, but just because it's a good occasion to talk about Schutz and Simmel and Husserl. So the other tradition is the performativity tradition, and the problem is that I think they are interested in markets. They are interested in markets that are being stabilized. They are interested in the process of stabilizing and creating markets. What I find most interesting in the financial markets is the fact that nobody actually is trying to stabilize anything. The only reason they make profit is by destabilizing on a continuous basis, and so that's why I think the notion of derivation. And I didn't really elaborate it, but the notion of derivation is in a way, for these markets, is richer than the notion of performativity.
Can you briefly explain maybe for people who can be trained okay, we show that financial instruments are constructed. We show that it's abstraction. But does it mean, like, Harry Collins that we show the constructive nature of science and we need to use scientific policy? Do we need some control instrument or maybe some practical organizations?
I didn't get that. I'm sorry. So I show that instruments are created, constructed.
We show the constructive nature of financial instruments.
Yeah.
Okay.
I mean, I think everybody is fine with that. Everybody is fine with that, I suppose.
Does it mean some practical recommendations, like for people who haven't really...
So what are the practical recommendations based on that?
In terms of regulation of these instruments?
Yeah.
Oh yeah, no, they are very practical. So one of the problem is that there is a huge disparity of, the disparity of expertise between these financial institutions, between the financial industry and the regulatory body is ridiculous. Nobody is going to work for the SEC. Nobody was going to work for Commission Bancaire in Paris in the 2000s because you were basically lectured when these regulators were coming to the bank. They would be lectured by the financial engineers on how to actually assess the products they were designing. So one of the things that one of the recommendation would be to rethink the need for secondary markets. Okay. And it's a huge problem because if you think of the US economic history, secondary markets is sort of constitutive to the US economy. If you tell people you can trade once, the product is going to be issued, you are going to buy it, you won't be able to sell it. There won't be any secondary market. That goes against the grain of something that is fundamental to the US, which is you trade and you slowly collectively progress to the right price, so that you slowly collectively progress to a better nation. Okay, but I think this is the idea, is that for some of these products there shouldn't be any secondary market, which runs against the idea that secondary markets are also a way of evaluating the risk. So I know there is a tension there.
Well, thank you.